Forex market. Today I want to talk about Forex market, which is really trending in these days, and it has a huge world. Hey besties, how are you doing? I hope you are doing very well as always, and also I'm really glad that you are here with me. Today, as I told you in the first of the video, we want to talk about Forex market. We want to get some important information about this market, and also we want to learn some basic information, something about leverage, about buying, selling, or the long position or short position. Before we are starting this video and we learn something together, don't forget that please subscribe my channel if you don't have my channel, and also ring the bell. If you have any problem, any question, you can tell me in the comments, and also I put some link in the description of my video. You can enter from there and make an account for practicing in Forex market. Stay with me. Okay, today we want to getting a start in the Forex market. Before that, we should have some information. We should know what is exactly Forex and why we choose Forex market. Because this market is where traders from around the world can and all these traders can trade in currencies of global countries. And the Forex market is the largest financial market in the world with an estimated, I think something about $4 trillion every day. It's the number that I said is about a daily. And if you want to get a sense of just how large this market is, consider that the amount trader in 4 days could pay off the entire United States debt. That's it. Of course, not only does Forex offer the benefit of being the largest market in the world, but through trading currencies, it's naturally also the most liquid market available. Forex is at first seamless and decentralized 24-hour market that follows global banking activity from one international market to another. Unlike in other markets, Forex trader can trade 24 hours a day from Sunday through Friday. At first, the thing that we should know is the first thing is leverage. What is leverage? Currency trading can be significantly and flexibly leveraged. Outside of the United States, the leverage is up to 200. It's meaning that traders can put up $1 but control up to $200 in emerging trade. While this would magnify your profits, leverage can also magnify losses. Okay, let me explain you completely. For example, sometimes you have your amount is about $10. Okay, you put that and you choose the leverage. For example, you choose your number of the leverage is 10. Okay, if you the position is closed, for example, and you get TP, the amount that you get from there is 100. And of course, it's we have the vice versa of that. For example, you can lose something about more than these things. After that, you should practice the accounts. Forex is an easy choice for those seeking entire trading market. Trading can begin on a free practice account and then progressive to a live account with a low deposit minimum. What is a practice account exactly? You should register for a free practice account on this site that I put in my description of this video. You can enter from there. After that, when you sign up, process is quick. After that, when you sign up in that, your process is quick and simple. That's it. Okay, we want to know something about the mechanics of currencies trading. We have two things. First one, buy, and the next one is sell. Forex trading is the buying one of the currencies while simultaneously selling another currency. What does it mean? These currencies expressed in pair are always connected to each other, as the value of one currency can change unless it's compared to another. Trading in this marketplace is unique because there are equal opportunities to buy or sell these currencies pair. If you buy a currency pair expecting it's to increase in value, you are going long. Yeah. If you sell a currency pair expecting it to decrease in value, you are shorting. Whether you are going long or longing or shorting in this market, one currency is always growing stronger against another, and one currency is always growing weaker, creating an opportunity for any type of trader. That's it. Look at here, I put the picture here to understand better. Look at this one. This is means buy. When they say, for example, if you buy a currency pair expecting it to increase in value, you are going long. You are going long or buy that. If you sell a currency pair expecting it to decrease in value, you are shorting or you are sell that. Look at here, I bring a trend for you and you can get that. And we have the two primary reasons people trade Forex are for. Okay, we want to check two reasons. What are they? The number one is speculating. 7 to 80% of the Forex trading is for pure speculation. People who trade for speculation expect to benefit from the change in value of one currency versus another currency. Similar to how a trader might speculate on the change in stock value. And another one is conversation. Conversation is something about 20 until 30% of daily forex activities for conversion or delivery. If McDonald's Corporation wants to convert the Japanese yen, profit from selling hamburger in Japan into a domestic US dollar, they would transact with another counterparty, usually a bank or something, to sell GPY in exchange for USD. And I told you, when I was talking, I told you something about currencies pairs. What is currencies pairs? The value of each individual currencies is related to other currencies, and for example, the euro, for example, only has value of compared against the value of another currencies like the US dollar. That's why currencies are traded in pairs and not as single currencies. Also, currencies pairs are just that, individual currencies that are paired of. Example include Euro USD, which is the euro against the US dollar, and another one, for example, USD JPY, which is the US dollar against the Japanese yen, USD yen, and something else. The first currencies in the pair is called the base currency. The second currency in the pair is called the quote, or country or a counter currency. If we say that the current price of Euro USD is quoted and an exchange rate of 1.2000, this would mean that 1.2000 of the quote currency, the USD, is equal to one of the base currency. And look at here, I bring something here for you. Buying a currency pair is the same as buying the base currency while simultaneously shorting the quote currency. By the same token, selling short currency pair is the same as selling short the base currency while simultaneously buying the quote currency. For example, if a trader thinks that the base currency will go up in relative value while the quote currency will go down in relative value, that trader should buy the currency pair. If instead a trader thinks that the base currency will go down in relative value while the quote currency will go up in relative value, that trader should sell short the currency pair. That was whole thing about this part. About currency pairs, what are they exactly, and some subject extra. If I want to tell you about something about currency pairs, let us check that. Listen, Forex Trading offers a limited number of trading instruments, for example, namely currencies, to help focus trading efforts on a few key currency pairs. In addition to the major currencies pair, Forex also offers trading on the commodity pairs and for example Australian dollar and USD or CAD and Canadian dollar and the major crosses something. What is also commodity pair? These pairs are highly correlated to certain commodity prices. Generally speaking, the UD, USD and USD NZD correlate with gold price and USD CAD correlate with oil. That's it. And what are the crosses also? These pairs don't contain the US dollar. Look at here, I put something here. Most traded pairs is Euro USD, USD Yen, and GBP USD and USD CHF. And also you can see another one. The things that's important here is that the most common currencies traded are the USD dollars, Euro, Japanese yen, and British pound. And the most common currency pairs traded are Euro USD, GBP USD, and USD yen. Another thing that we have is pips. What is pips? Pips are the primary units of movement for all currencies per exchange rates. For example, if your USD moves up from 1.2 thousand to 1.2001, that is a bullish movement of 1 pip, which in this case is an exchange rate movement of 1 or tenth of 1 USD. Major currencies pairs can routinely move hundreds of pips per day, every day. That was the first part of Forex market. We have some part for you to understanding and learning better this market, and also understand completely every part of this market. Don't forget that if you want to don't miss any video, ring the bell. And also if you don't have my channel, please subscribe my channel. I will wait for your opinion in the comment of my video. I will answer all of them one by one, and let us communicate together for learning very